There's a powerful consensus emerging among economists, investment banks, and financial analysts that gold prices could surge dramatically between now and 2026, possibly even breaking above $5,000 per ounce. But this isn't a wild prediction from fringe investors. It's a view being seriously discussed by major institutions like HSBC, JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America, Deutsche Bank, and UBS, all pointing to structural forces that could reshape the gold market. Gold's remarkable rally in 2025 set the stage. After decades of trading in the $1,000 to $2,000 range, gold's price exploded, climbing over 60% in 2025 alone and breaching the $4,000 per ounce mark for the first time in history. Many analysts see this as more than a temporary surge. They see it as the early chapter of a broader structural shift in how the world values monetary assets, risk, and currency stability. So why are these experts talking about $5,000 gold by 2026? Let's break down the key driving forces that could push gold to new territory. 1. Central banks are buying gold. Like never before. One of the strongest structural pillars behind the bullish outlook is the scale and persistence of central bank purchases. Over the past decade, official sector demand for gold has grown aggressively as governments diversify away from traditional reserved assets like U.S. Treasuries and other fiat currencies. Even through 2025 and into 2026, central banks continue to be net buyers. In many cases, purchasing gold at levels not seen since before the 2008 global financial crisis. Institutions like the World Gold Council report that many central banks plan to maintain or increase their gold holdings, viewing it as a hedge against currency risk and geopolitical instability. A bullish forecast by Deutsche Bank even suggests that continued to inelastic demand from official sector buyers alone could support gold prices near $5,000 per ounce in 2026. 2. Low interest rates and monetary policy support. Gold is fundamentally a non-yielding asset. It doesn't pay interest or dividends. So when real interest rates, the return on interest-bearing assets minus inflation, are low or negative, gold becomes more attractive by comparison. Many analysts point to expectations of continued interest rate cuts by the U.S. Federal Reserve and other major central banks in 2025 and into 2026. Lower rates generally reduce the opportunity cost of holding gold, which tends to boost demand from both institutional and individual investors. Add to that a weakening U.S. dollar, a common consequence of sustained rate cuts, and you have another tailwind. Because gold is priced in dollars globally, a softer dollar naturally raises gold prices in local terms for holders of other currencies. 3. Geopolitical risk is driving safe haven. Demand gold has always been considered a safe haven, an asset investors flock to in times of uncertainty. In recent years, that narrative has strengthened as global geopolitical tensions have increased. From ongoing trade and political friction between major powers to conflicts in Eastern Europe and the Middle East, the sense of economic and political instability has propelled gold's appeal. Analysts often note that when uncertainty rises, risk assets like equities tend to falter, and gold tends to outperform because it is perceived as a store of value with no default risk attached. This safe haven dynamic is part of why analysts believe gold isn't just rising. Because of technical trends, it is responding to deep macroeconomic concerns that are unlikely to disappear quickly. 4. Sluggish supply meets growing demand. Another critical factor supporting the idea of higher gold prices is the supply-demand imbalance. Unlike many commodities, gold can't be ramped up quickly in response to price signals. Mining new gold deposits takes years, often a decade or more, to move from discovery to production. Meanwhile, existing gold supply is being absorbed by central banks, exchange-traded funds, ETFs, and long-term investors, leaving less available for speculative trading or jewelry demand. Deutsche Bank and other analysts point out that even incremental increases in mined gold production done ET come close to keeping pace with current demand trends. As a result, with supply relatively inelastic, increased demand, especially from large institutional buyers, puts pressure on prices to rise. 5. Diverging analyst forecasts, but a bullish consensus. While not all analysts agree on the exact price level, there's a clear trend toward higher price expectations in 2026 compared with previous years. For example, Deutsche Bank recently raised its forecast, expecting gold to trade in a broader range that could approach $5,000 by late 2026. Morgan Stanley projects gold reaching around $4,800 an ounce by the fourth quarter of 2026, while other banks like UBS and Bank of America see prices climbing well above traditional historical ranges as demand persists. Even HSBC, which offers a more conservative range, acknowledges that gold could trade between roughly $3,150 and $5,050 in 2026, highlighting the potential for very wide price volatility and upward breakout. 6. Dollar weakness and inflation concerns. Economists often highlight that gold acts as a hedge not just against inflation, but against currency debasement. In an environment where fiat currencies face pressure from expanding central bank balance sheets, rising debt levels, and political uncertainty, gold's appeal strengthens. Prominent investors such as Ray Dalio have tied gold MBRE's recent rally to concerns about the weakening dollar and broader confidence in fiat currencies. In his view, gold AS outperformance relative to traditional financial assets reflects deeper economic warnings, not just short-term market movements. When investors anticipate that fiat currencies might lose purchasing power over time, they often allocate more to gold as a protective measure, further fueling price support. 7. Retail and institutional demand. Keeps pushing upward pressure. It's not just central banks and institutional forecasts behind the bullish outlook. Retail investor interest, particularly through gold ETFs and physical bullion, has also surged. Many analysts note that ETF flows remain robust even as prices climb, indicating that investors are not selling into strength. They're accumulating. This is significant because in previous rallies, large price advances often resulted in profit-taking. In contrast, current behavior suggests broader conviction in gold's long-term role, strengthening the case for sustained higher prices. 8. Is $5,000 a guarantee? Not exactly, but it's very possible. None of these forecasts are certainties. Analysts are always cautious to point out risks. Potential easing of geopolitical tensions, a stronger dollar, or unexpected shifts in Federal Reserve policy could temper gold's ascent. But the trend is unmistakable. Most price models now incorporate real structural shifts rather than short-term speculation. The convergence of central bank demand, macroeconomic policy, safe haven behavior, supply constraints, and weakening fiat currency narratives create a powerful environment for continued gold strength in 2026. What this means for investors and the global economy. If gold does begin to approach or exceed $5,000 per ounce, the implications are broad. For investors, it could signal that traditional markets are pricing in deeper economic uncertainty. For currencies, a stronger gold price often reflects weakening confidence in fiat money, especially the US dollar. For central banks, it may accelerate further diversification away from dollar-dominant reserves. For markets, a sustained high gold price could act as a drag on risk appetite, influencing equities, bonds, and foreign exchange markets.